that thinking of equity and bonds being quote unquote normally negatively correlated, that's more based on the past, call it 30, 40 years. In the very long terms, actually equity and bond markets being positively correlated and not negatively correlated.
I tend to think about risk in two different ways. One is volatility. The other is permanent capital impairment.
When the housing crisis struck in earnest in 07, 08, the Big Short and the likes.
Those types of systemic risks often don't start in equities themselves. They may come from credit markets, liquidity problems, and broader macro imbalances, even from war. So yeah, we just talked about volatility and long volatility, how to use it. And from my perspective, it feels like the market environment today is very different from even 5 or 10 years ago. Daniel, I know you've been working in derivatives, volatility, and global macro strategies for many years now. How many years actually?
Well, it's now, I mean, in hedge funds and investing in hedge funds, it's now just shy of 20 years, I'm afraid to say. And yeah, basically, I mean, as hedge funds are very much intertwined with derivatives, it's almost the same.
Wow, that's very valuable experience. So looking back over that period, I mean, in the very beginning, when the option market just developed, what was volatility for most of the investors, and what is volatility for investors in current markets? How has your view of volatility changed, and what do you think are the biggest long-term changes in markets that have made volatility strategies more relevant today?
Right, right. Well, I think back almost 20 years ago, I think it's already been a huge market, a huge global market, volatility back then. You might remember that then when the housing crisis struck in earnest in 07, 08, also reading books like the Big Short and the likes. It's been very much also about CDS and CDX and actually credit insurance, right? Credit protection strategies and credit default swaps. And that's also a form of optionality, and by that means a form of volatility, in that case on credit as an asset class and different credit instruments. So I think it's already been huge back then. Of course, it's grown further since then, like most of the financial market, it's grown even further. And maybe one other key change compared to then, even though even then relatively vanilla or classic options and forms of volatility were already accessible also by retail investors and by the broad market. I think today and for many years now, with this phenomenon of highly levered, very short term, single stock trading investors, you might have heard the acronym YOLO and the likes, and all the technology obviously that's enabled it. So all the platforms, all the web-based investing and social media, etc. That's probably even put more fire, so to say, to that side of the volatility market.
Yeah, so it involves, along with the technology and the financial market. And also, as I just mentioned, the market environment today is very different from before, very volatile and unpredictable. And in the bond markets, 10-year US bond, and still there, very high. And also the equity volatility, the government debt, the physical deficits. We are trying to put the long volatility strategy in our portfolio as a diversification. If unfortunately we really experience a period of stress, then we can at least reduce the maximum drawdown, or even we can earn money from the tail risk. I think that's how people's view of volatility changed. So it's more and more important. And also, traditional assets like equities and bonds already move more in sync. So how do you see that shift based on your 20-year experience in the finance market?
Actually, I should mention there that in the very long term, so basically for as long as there is more or less reliable financial market data and continuous financial market data, actually there has been more often than not a positive correlation between equity and bonds. So, I mean, it's been far from continuous, so it's been, but there has been a slight majority of actually equity and bond markets being positively correlated and not negatively correlated. So that thinking of equity and bonds being quote unquote normally negatively correlated, that's more based on the past, call it 30, 40 years, right? And so you could still call that a long history, but there is more history than actually the past, call it 40 years. And so actually, so this swing back to positively correlated equities and bonds for the past couple of years, you could actually call it more a return to the norm rather than an exception.
Yeah, so do you think the traditional portfolio construction is no longer sufficient in today's environment from your perspective?
I mean, there is still value, right, to traditional portfolio construction, and it doesn't mean that the baby has to be thrown out with the bathwater, so to speak, right? So it's not, it didn't flip from all right to all wrong. However, that being said, I think, and we think it's at least incomplete, right? And but that means we think you can do better. You can add some further improvement by adding, for instance, just as one example, some forms of volatility, and especially long volatility. Of course, there's also other ways to improve a portfolio, which we are not expert in, right? That's why I'm not going to go into those areas, but I'm sure there is more areas. But I just think that purely equities and bonds and other, more traditional asset classes, I mean, thinking even real estate, ultimately it is sooner or later often correlated with either bonds, duration, the interest rate factor, and also equities in every once in a while, right? Depends on what exact forms of real estate we're talking. So I think those are all assets, and volatility is really, as I said, another dimension to these. And so it can actually add another dimension to portfolio diversification.
Yes, you are right. So we don't want to abandon, equities and bonds because equities and bonds are still our core engine of, compounding returns. So, but we can add the volatility strategies, so negative down correlation to our traditional portfolio. We discussed the long volatility before, and you mentioned the idea of reliably negative down correlation. What's that? What's the negative down correlation, and why is that so difficult to achieve in practice?
Sure. I mean, correlation overall, right, as I'm sure you know, is a statistical measure for expressing on how much two different assets or time series are in sync or not, right? And if they are very highly positively correlated, they move almost perfectly in sync or in lockstep, and vice versa. If they're very negatively correlated, they move almost in an almost perfectly opposite way to each other. So asset A being up, then asset B being down, and vice versa, right? So that's a very negative correlation. Now, us emphasizing the down correlation, the negative down correlation is, it basically means that we target to be as much as negatively correlated as possible in down markets, right? So that's why we emphasize the down element so much, because that's actually when markets are down and selling off, that's when you actually need a negative correlation, or that's when negative correlation we think is most valuable, right? It's obviously not when markets are up. Ideally, you would also be positively correlated. You would be up too in an ideal world, although that's a bit maybe ask too much of any financial assets in the world. But down correlation, that's really when markets are down. the diversification and the protection element, I think that's when it's key. And that's why with this down correlation measure, we only measure the correlation of a given investment strategy to the financial market, so to equities, for instance, when equities are down, only in those periods when they are down, because that's when protection actually counts. And so we have a slightly more, we did this tweak to the statistical measure to make it a bit more specific and hopefully a bit more reliable as well.
Yeah, thank you. That is a very new and very important concept for me, down correlation. Since we want to protect our old portfolios, we should focus more on the down correlation, because when assets going down, if all the assets in your portfolio moving in sync, that's a big problem. But if all the assets in the portfolio are moving up, that's okay. We're happy to see that happen, right? That's why we have to focus on the down correlation. Thank you, Daniel. I really learned a lot from you. Lots of new concepts and new areas I should focus on. And also, in my own framework, I tend to think about risk in two different ways. One is volatility. We talked a lot. The instability and disorder of markets. The other is permanent capital impairment, right, which often comes from tail events. You just mentioned the Big Shot, a very memorable movie, making the retail retail investors know well about the 2008 the tail events and the systemic crisis. I think the retail events and the systemic crisis, they often make a permanent capital impairment. That's very serious. And interestingly, those types of systemic risks often don't start in equities themselves. They may come from credit markets, liquidity problems, and broader macro imbalances, even from war. So when we talk about long volatility strategies or volatility strategies, are we really talking about something much broader than equity protection?
Yes. So it actually, even in 2022, when it also was also very much a bond sell-off, right? An interest rate-driven equity sell-off as well. It was, in hindsight, relatively short, but nonetheless very intense in terms of statistically measured drawdown, intense period of stagflation, stagflationary period to a certain degree. And so, yes, long volatility very much is also meant to be long inflation or to protect against inflationary effects, right? Hitting the bond market and the fixed income side of financial assets. So that's the aim, right, of those strategies. But then it's also the ingredients, what goes actually in there. And so when we implement long volatility strategies, it's very much cross asset class. So it's fairly balanced between not only equities, but also interest rate volatilities, credit volatilities, currency volatilities, and to a certain degree also commodity volatilities. So it's really meant to be very broad, because our thinking is the broader we cast the net, so to speak, for potential volatility spikes, potential volatility opportunities, the more often we maybe catch something every once in a while.
Okay, that's wonderful. Eventually, we have strong tools in the bond markets, equity credit markets, equity markets, and even to avoid some risks coming from the macro.
Potentially, yeah, potentially, but it's not a perfect hedge, right? Just to be clear, there's no guarantees. Anything coming with a so-called guarantee, I think it should be we should all be very skeptical of that. I'm sure you know.
Yeah, of course, there's no guarantee in the finance market.